Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on March the 2nd. It's a Tuesday, and the year is 2021. Let's talk trading. So, tactical trading, risk, money with Walmal. But just remember, these videos are for educational purposes only. Your results may differ from mine and from Walmal's. So, Walmal, yesterday I talked about tactical trading and risk and money. So, I'm wondering if you can give the traders your spin on it, and if you could maybe frame it around the Walmal method. I think that might help a lot of people out there.
Sure, no problem. Yeah, I love the title tactical trading because, what we have to do is we have to be very, very deliberate in what we do in trading, and deliberate in our way of entry, deliberate in our way of exit, deliberate in the way that we manage risk, and deliberate in the way we manage our money. And so, yeah, it's a great, great title. I'm sure you covered this yesterday, but, when you first get into a trade, the reality is what you're managing at that moment in time is you're managing your risk. You're managing risk until you get across that zero line, and now you're, potentially managing money. So there's a delineation that happens there, and I think you had just mentioned to me that there was somebody asking a question that why not just put the stop loss at 10, and or instead of going, what I normally do is I try to get out at 7. Well, what I did was in my trading plan, what I did was I figured out that for me personally, there's a set amount of money I'm willing to lose on any one particular trade, whatever that may be. And so what I like to do is, before I even hit that amount that I'm willing to lose on that one particular trade, I'm willing to get out, maybe a little bit earlier than that. And the reason why is because a lot of times, let's say you went and set your stop loss at 7 pips. A lot of times the market will, you just don't, that's an emergency stop. You're getting out, you're taking it at market level. And a lot of times, you know what? You don't get out at 7. You punch out at 7. A lot of times you don't get out at 7. You'll get out at 8, 9. Sometimes I think the worst I ever got out was 15. That very easily can happen. Imagine if I waited till 10 on that one trade where I got out at 15. Very easily I could have gotten out, at that point at, 20 or 25, something like that. So that's just a way for me to manage my risk. I don't want to go over that limit. And when I say how much am I willing to lose on a particular trade, there's a lot of components to it. There's cost of business, what I call cost of business. There's a cost for going and taking a trade. What is that cost? It's your spread. If you're on an ECN broker like I am, it's your cost of your commission. All those things have to be filtered into that. And another cost of business is that when you're exiting a trade, like I just said, sometimes you don't get out. Just because you went and punched out at 39.17.3, it doesn't mean that you're going to necessarily get filled at 39.17.3. So I like to have a little bit buffer in there between what I'm willing to lose on a trade and what I actually, what may actually happen. And that's the reason why I do that. It's just the idea of just trying to go and, I'm always, if you look at the PDF, somebody else was, I didn't do it, but somebody else was nice enough to take my trading plan. I had posted it on Crestlick, and somebody else was nice enough to take it and repost it, I think, in the Facebook group. But if you look at that, the number one thing I have in there in big capital letters, and I think I even put it on, on every single page, and that PDF is like 2 or 3 pages long, but, on every single page, at the top of the page, it says one thing in big red letters: preserve capital at all costs. And that's risk management. I'm not willing to go and give back, and that's just simply the case. And, that's just part of what I do. Now, somebody else may say, you know what? I'm going to go and say, well, if you're going to do that, why don't you just go and make your hard stop at 7? That's fine if you put that into your trading plan. I chose not to. It's easier for me to manage things that way, and so what I do is I put my hard stop in, as an actual order in the market at 10 pips, but I try to exit out at 7. Why do I have both of them there? Well, I'm human, and we all are, and the thing is, I may go and, be sitting in a trade and, where let's say I'm down 3 pips or something like that, down 4 pips, and I turn around to go get my cup of coffee and turn around, and next thing you know, I'm down, I'm now getting stopped out of 10. Well, that's great because that's why that's the reason why I have it. It's an emergency stop loss. It's just a way to get me out, when I have to. But at the same time, if I hadn't taken that sip of coffee, probably as soon as I went and hit that -7, I would have punched out to try to minimize the loss on it.
So we're going to call it the coffee stop?
The coffee stop. There you go. Yeah, but that's just what works for me. And everybody, TR, we've talked about this on videos. We've talked about it, personally together. Every one of us is, as traders, first and foremost, what we are is we're people. And being people means that we all go and do things differently. We all have different risk appetites. We all have different, ideas about how to go about it. And we have to go and take those things and incorporate that into our trading. And so for me, I'm one of these people. TRO, he goes and makes fun of me about this, but in high school when I graduated, I got a scholarship, and the scholarship was the Thrift Award. And essentially, what it meant was I was the cheapest person on campus in high school. That's me. And so knowing that that's who I am, well, of course I'm going to go and do something. I can say my hard stop is at 10, but then I'm going to look to get out at 7 because I don't want to lose any more money than that, because that's who I am. I'm a very, very frugal person. And so for that reason, I need to, I need to go and match who I am as a person with my trading style.
But you found that out over years, though, right?
Oh yeah, that's exactly right. It does, I knew that it was always cheap, but the problem is, it took me a long time to figure out in terms of trading that, hey, I got to match my trading up with who I am, and one of the things that I think is kind of funny is that I've talked to a number of aspiring traders, and I say to them all the time, don't trade like me, trade like you. And, of course, people get upset with that, and they go and say, but I'm not making money right now. And I said, well, maybe it's because you're trying to trade like somebody else. Trade like you, and then find out what works for you and manage your risk that way, and manage your money that way. If you're a type of person, that that you're overly greedy and you're in the money, okay, that you are that way. So find a way to go and incorporate who you are as a person. If you're an overly greedy person, find a way to go and get yourself out before it turns around and you lose everything that was on the table for you. That way, it's better to pick up some scraps than pick up nothing. So find a way to go and do that. Find a way to go and match who you are as a person with who you are as a trader. Because if you're a different person as a trader than you are as a person, you're not going to be successful. It just won't happen. And like I just said, sometimes it takes a long time for us to go and do it. We go back and we look at the charts. If I only use this method, look, I can make money here, and here. And I could be up 100 pips a day. Yeah, you could maybe. But the problem is, if you don't go and trade it based on who you are, then you're going to fail, because that's the whole idea of this whole concept of tactical trading. Part of tactical trading is knowing who you are so you can manage your risk. Know when to get in, know when to get out. And getting in and getting out, both part of risk. And also, money management. They both play a part in that. Now, in terms of money management, what I personally do with the Walmal method, is a 10-5-1 idea. Excuse me. But with the idea there is that, I'm shooting for 10 pips on a trade. And knowing that, shooting for 10 pips on a trade, some people I've seen in the forum say, well, that's only 1-to-1. You're right. It is only 1-to-1. But because I'm usually trying to get out, if I get into a loss at 7, it's really more than 1-to-1 risk-reward scenario. Sorry about that.
Yeah, well,
so
I was going to say, a lot of people, they read these books or forums or listen to somebody else's videos, and they get hung up on one particular thing that, in this case, the risk reward. Sure, you'd be managing, part of the equation, but once again, you can only really manage that risk side, or really, or control the risk side, because on one trade the market might give you a pip, on the next one it might give you 10, on the next one it might give you a potential of 100, but you don't know that going into the trade. So if you see something and it says, hey, I got this pip and the market stopped and I got a one ball in front of me, it's something, and you just punch out. And then what could happen? It could either run up to 100, then you kick yourself, or it could drop, 100, and you're going to be thankful. So, but that's, I think the word they call that is resulting. I was listening to an Annie Duke podcast, and for those of she's the woman that won the World Series of Poker, and she wrote a book, Thinking in Bets. And I think she's just come out with another book recently. I can't remember the title of that one. But, she says that it's resulting. And the one example she loves to use is the Super Bowl, where the Seahawks lost because they threw that pass. They go, they should have just given it to the Beast and let him run it in. But the thing is, the Beast had something like a 40% chance of success, versus the pass had something like a 0.2 or 2% chance of getting an interception. So the pass got interception, and everybody was saying it was a bad call. But if it hadn't have been interception, they scored a touchdown, they'd say it was a brilliant call. But that's called resulting. You're determining, you're going backwards and saying at the time you made the choice, that was the best choice. But now you're saying, oh no, because of how it turned out, it wasn't the best choice, which is wrong.
You're exactly right there, or she's exactly right there. It's you look at the charts, and it's so funny. It's so easy to make money on the charts from the past than it is to go and make money on the charts, that are actually currently happening. And we make so much of this, idea of some indicators that go and repaint. I would go and say that most indicators don't repaint. What they actually do is they just dynamically telling you what's going on at this moment in time, and you're making decisions based on that. But the thing is, you can't, a lot of times, back testing a lot of times just doesn't work. And the reason why is because you're not getting the full story. You're not seeing the whole picture, because you're missing the piece of what actually was happening at the time when the candle get painted. I mean, even if you go down to the smallest amount of time that's there, it's still compressed data, and it's still 1 minute of data that happens, that you happen to see in that back test mode. Whereas, let's say you have a 1 minute candle that looks like it went up 10 pips across the line, and it looks like it went up 10 pips. Who's to say that, it went up 10 pips, but, it also, in that time went up 5 pips and then ran all the way back down to 0 pips, and you got out, maybe at break even, so, that's why back testing sometimes, it really is not nearly as effective as forward testing. Going and actually trading what you see and seeing how that works. But going back to the Walmal method, the whole idea, I'm trying to get 10 pips on the money management side. But you know what? If I go and see that, hey, I'm at 5 pips, what I'm going to do is I'm going to protect some of that money on the table. I'm going to make sure I have 0 risk left. I'm going to eliminate risk. And there's no better feeling in the world than being sitting in a trade and you've got 0 risk. No matter what happens, you will not lose money. Okay? And so that's why when I get to 5 pips, immediately I go to break even plus 1. Because the worst thing that's going to happen, if I get to break even plus 1, the worst thing that's going to happen is I'm going to make 1 pip. And let's say I'm going and trading, 5 lots on that, just as an example. I don't know what y'all are trading at, but let's say you're trading at, 5 lots. Well, what is that? Well, you just put $50 in your pocket. You've guaranteed that when this trade ends, eventually it's going to end, you're going to go and walk away with $50.
And you know
That's
what?
a good feeling.
This is the fastest 15 minutes in trading is up. Boys and girls and non-binary traders. So I hope that helps you, and we'll definitely be revisiting the topic. So Just remember, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.